This is another in our series of trading biases, and in this one we're going to look at a real problem for lots of traders that can handicap them when it comes to their approach to markets. Hello, I'm David Jones from Capital.com. This is the latest video in a series we're doing where we look at some really common trading biases. Our trading platform has an algorithm that tries to detect if a trader has a certain bias or has maybe picked up bad habits along the way and suggest information to maybe help them refine their trading approach. In this video, we're going to look at the problems of traders who only ever trade in one direction. Now, to more experienced traders, you might be surprised by this, but more than half of people never sell short. So they really do handicap their approach when it comes to falling markets. So first of all, let's explore this problem in a bit more depth, explain in theory how we can do it, how to trade markets in both directions, and then we'll go through a real example, short selling the Dow. Now, this trading bias is much more common than you might think. There are lots of traders out there who only ever trade in one direction. So what they're not doing is short selling. Let's just take a step back. Markets move up and down. If you've ever looked at a market, whatever it is, you know that. Markets do not move in one direction forever. But many traders only look for opportunities to buy. This is also known as going long in market terminology. So regardless of what the market's doing, whether it's going up, down or sideways, there are plenty of traders out there who'll only look to buy. This can be a costly approach in falling markets. If you have a market that's been falling for weeks, for days, for hours, the last few minutes, then obviously, probably the sensible way of trading is looking to trade with the trend, and that trend is down. It can be costly trying to pick the bottom in a falling market. So when trading CFDs, it's really important to understand you can trade markets in both directions. So if you think a market is going to fall further, you can profit from a falling market by short selling. I'm going to go through the theory of this in a minute, and then we're actually going to look at a real example. So what is short selling? Well, when going short, to open up your trade, you sell first, and then you're looking to buy back later to close the position. And this is the thing I think that maybe confuses a lot of people in the beginning, which is why they don't do it. This idea that you can open a trade by selling first of all. You don't always have to buy. If you think a market's going to go down when trading using CFDs, you can short sell. So by selling first, let's say we sell at 500. If the market does fall, let's say it falls to 400, then if we're buying back lower, we're going to profit. Of course, if our view is wrong and the market goes to 550 and we close the position at the higher price, then we'll lose money. But short selling is exactly the same as buying, expecting a market to go up, but in reverse. So we open up the position by selling first of all, hoping the market is going to fall, and we can buy back to close the position at a lower price. So let's say, for example, you thought the Dow was going to fall from 25,000 to as low as 24,000. You'd open a trade by selling first at 25,000. And if you're right and the market drops to 24,000, then you're going to profit by closing the trade by buying back. But of course, you can close the trade whenever you want to, whenever the market is open. So in that position, you'll short the Dow and you'll profit if the market falls. As usual, you can place stop losses above your entry point to manage the risk. So from a risk management point of view, you can do the same things you could do when you're going long. So if you sold at 25,000 expecting the market to drop, you could place a stop loss at, for example, 25,250. And if the market rallies to that point, then your trade will be closed out for your manageable loss. But let's look at a real example. So we're on the trading platform, we're looking at the market, and the Dow has actually slid quite heavily in the last few days. It's gone from 25,560, currently trading just above 25,000 down here. Let's say we thought, well, actually, this market is going to fall further. We want to sell short. Let's bring up our dealing ticket. So I think the market is going to drop. I'll click up to choose the quantity I want. I'll just do 0.1. My margin requirement is there. I'm going to sell, so I'm opening the trade by selling first. So now I'm short the Dow. Let's take a look at my positions. So there you can see the trade. So I'm short. I went short at 25,024. The market has dropped really sharply. It's dropped very quickly to 25,000, nearly 25,000. I've just done a small trade and there's my profit, my running profit so far. So I've put a trade on to try and profit if the Dow falls. The Dow has slid quite a few points since I opened the position. So there's my profit or loss in real time. And if I change my mind, I can just close the trade. I close the trade now and I can book a small profit for a slide in the Dow that I made by selling short. So it's important to understand you can trade markets in both directions. Don't be one of those traders who limits themselves by just trading it in one direction. So hopefully you can see how straightforward it is. It's like buying and selling, but you sell first and buy back later, and you're hoping to buy back later lower. And you can see in the Dow example, that worked well because the market dropped about 20 points. But the principle is we want to open ourselves up to all sorts of opportunities in the market. So the ability to sell short and actually looking for short selling opportunities is an important part, I think, of any trader's armory when it comes to trading financial markets. We'll wrap things up there. There's a whole host of other videos in this series, so make sure you watch those. We also, during the week, upload content where we look at various individual markets, different trading approaches, that sort of thing. So if you're subscribed to the channel and you click the alarm bell, you'll always get notified when one of these gets uploaded. But for this session on looking at short selling, from me, David Jones, and Capital.com, we'll wrap it up there.